Imagine if a geopolitical crisis, half a world away, suddenly made your oil imports dramatically cheaper. Imagine tankers rerouting from Europe to Asia, offering cut-rate crude to any buyer willing to brave Western disapproval. Now imagine this is your country's big chance. This scenario isn't hypothetical for India. It's exactly what unfolded after Russia's invasion of Ukraine. Practically overnight, India went from barely buying Russian oil to becoming its #1 customer, seizing an economic lifeline that few saw coming. How did India manage this remarkable pivot? How did a war in Europe translate into an oil bonanza on the subcontinent? This documentary dives into the mystery. How did India become Russia's #1 oil customer, and what does it mean for India's economy? India's appetite for oil is immense. It is the world's third largest oil importer, relying on foreign crude to fuel about 85% of its needs, roughly 5 million barrels each day. For decades, India's supply came overwhelmingly from the Middle East, OPEC producers like Saudi Arabia, Iraq, UAE, and some from Africa. Until recently, Russia was a negligible player in India's oil mix. Distance and high freight costs made Russian crude uncompetitive, and in 2021 Russia supplied only around 2% of India's oil. New Delhi's strategic ties with Moscow were strong in other areas, defense, diplomacy, but energy trade lagged far behind. Ironically, a spat with its traditional Gulf suppliers had already primed India to diversify. In 2021, as oil prices doubled, OPEC Plus refused to boost output, a decision that infuriated India. The government publicly urged Indian refiners to seek alternate sources and not be held hostage by OPEC's pricing. This set the stage for India to look beyond the Middle East for oil. Still, Russian crude remained a rounding error in India's import ledger entering 2022. No one predicted that was about to change so dramatically. Then came February 2022. Russia invaded Ukraine, upending global energy flows. Western nations reacted with sanctions and import bans targeting Russian oil. For Moscow, a historic market, Europe, began to vanish. For energy-starved India, a historic opportunity appeared. Cheap Russian oil was suddenly on the table, and India was uniquely positioned to grab it. When war erupted, the West moved to starve Russia's war chest by cutting off its oil exports. The US, UK, and Canada banned Russian oil. The EU announced a phased embargo, and by December 2022, the G7 imposed a price cap of $60 per barrel on Russian crude. But this punitive strategy had a side effect. It slashed Russia's list of willing buyers, forcing Moscow to offer steep discounts to anyone outside the sanctions club. India sensed an opportunity and pounced. For a growing economy heavily dependent on imports, shunning Russian oil was never an option, especially not when it came at fire sale prices. The transformation was swift. Before the invasion, India bought almost no Russian oil. By June 2022, it was importing about 950,000 barrels per day from Russia. In a matter of months, Russia went from near zero to accounting for 13% of India's crude imports, leapfrogging Saudi Arabia to become India's second largest oil source. That's a massive increase in Russian oil inflows, an almost overnight realignment of India's supply chain. By early 2023, India was routinely purchasing over 1.2 million barrels per day of Russian crude, an unprecedented volume. This surge made India the top destination for Russian seaborne oil, filling the void left by Europe. In fact, nearly 2/3 of the Russian oil that used to go to Europe was rerouted to India by late 2023. Indian tankers and refiners eagerly absorbed barrels that Western buyers had shunned. From the West's perspective, this was a frustrating loophole. European officials watched Russian oil flow to India, get refined, and often flow right back to Europe as gasoline or diesel. EU Foreign Policy Chief Josep Borrell even mused about cracking down on India's resales. If India uses Russian oil to be a center where it's refined and byproducts are being sold to us. We have to act, he warned. But India's reply was unapologetic. External Affairs. Minister S. Jaishankar retorted that EU regulations themselves deem refined fuels as different origin. Russian crude is substantially transformed in a third country and not treated as Russian anymore. In other words, we're not breaking your rules. And indeed, India's relations with Europe and the US remained largely intact, even as its Russian oil imports ballooned. Western leaders have mostly refrained from direct confrontation with New Delhi over this issue, recognizing India's strategic importance and energy needs. Sanctions inadvertently turned India into Russia's oil lifeline. The G7's price cap, intended to hurt Moscow, instead handed India and China a buyer's market windfall. By shutting themselves out, the West ensured that India could dictate terms and get oil at rock-bottom rates. As one observer noted, the price cap ended up making India and China big beneficiaries of the discounted oil Russia was selling. India's message to the world has been simple. Our priority is our economy. At international forums, Indian officials quietly underscore that by keeping Russian oil flowing, India helped stabilize global prices and prevented China from having the Russian bargain bin all to itself. Geopolitics aside, the logic was clear. Cheap oil was on offer, and India wasn't going to miss out. Why was Russian oil so alluring to India? One word: discount. Cut off from its main customers, Russia began selling oil at heavily marked down prices to entice buyers. In spring 2022, Moscow reportedly offered its flagship Urals crude to India at $35 per barrel, below the pre-war price. To put that in perspective, Brent crude was over $100 at times in 2022. Russia was dangling a one-third off coupon in front of India. Even after freight and insurance costs for the longer voyage, these barrels were a steal. Throughout 2022, Urals crude traded far below the global benchmark. By late that year, Urals was around $53 to $58 per barrel on average, a discount of more than $25 compared to Brent. This gap was stark. For India's refiners, every Russian barrel meant savings, either through fatter margins or cheaper feedstock for domestic fuel. One analysis found that at the peak of the price divergence, Urals was $35 cheaper than Brent, which translated into about a $10 per barrel lower import cost for India compared to its typical oil basket. Multiply that by the millions of barrels India was importing, and you get a huge boon, effectively a discount dividend for the Indian economy. Crucially, India and China did not adhere to the $60 Western price cap in practice. They often paid above $60. Russia wouldn't sell to them at or below the cap, but still well below the market rates for equivalent grades. In May 2023, for example, India and China's combined purchases of Russian oil hit all-time highs despite US warnings, with India importing a record approximately 8.6 million metric tons, approximately 63 million barrels that month. These barrels did exceed $60, meaning traders and shippers had to take extra steps to avoid sanctions, but they were still a bargain. As the Institute for Energy Research noted, neither India nor China agreed to the G7 cap, and it clearly has not deterred them from buying above it. Russian crude was cheaper than Middle Eastern oil even when priced above $60, so India saw no reason to limit itself to the cap. Over time, as more buyers adjusted and oil markets fluctuated, the discounts began to narrow. By mid-2023, Urals delivered to India was not quite the throwaway deal it had been in 2022. Argus Media data, cited by analysts, showed Urals rising from around $70 in July 2023 to over $83 by August, as global prices climbed and Russia found stability. By late 2023, the gap between Russian oil and benchmarks shrank to single digits per barrel in some cases. Even so, Russian oil remained at least $3 to $4 per barrel cheaper than comparable grades from other producers. For large refiners dealing in huge volumes, a few dollars off per barrel is significant. Russia's pricing strategy was clear: undercut the competition just enough to keep India buying in bulk. And it worked. In fiscal year 2022-23, India's overall oil imports actually rose by 9%, even as prices were high, thanks largely to the rush of discounted Russian crude. Moscow effectively ceded some profit margin in exchange for market share, and India became the big winner at the till. Buying sanctioned oil at a discount is one thing, paying for it is another. How do you settle billions of dollars of transactions when the seller is largely exiled from the Western banking system? India and Russia had to get creative, and they did, devising workarounds in currencies and logistics to keep the oil flowing. Early on, there was talk of reviving a rupee-ruble trade mechanism. India's central bank set up a framework for foreign trade in Indian rupees, allowing Russian exporters to be paid in rupees deposited in special Vostro accounts. This would bypass the US dollar and shield transactions from scrutiny. However, this arrangement hit a snag. Russia quickly amassed far more rupees than it could spend. India's exports to Russia are paltry compared to its imports. Moscow grew reluctant to keep accepting rupees, which have limited convertibility. Indian refiners would have loved to pay in local currency, but as one official noted, the trade imbalance left Russia not keen to accept rupees for oil. Instead, third country currencies stepped in. The UAE's dirham emerged as a favorite. By mid-2023, an overwhelming majority of Indian purchases of Russian oil were being paid in Emirati dirhams, AED. Traders based in Dubai played intermediary, settling contracts in AED, a currency not subject to Western sanctions and conveniently pegged to the US dollar. This became the de facto channel for rupee to dollar conversion. Refiners pay rupees to an exchange bank, rupees get swapped to dirhams, and the dirhams go to Russia or its trading firms. Another alternative was the Chinese yuan. Some Russian suppliers, especially those with Chinese banking links, pushed Indian buyers to pay in yuan. In fact, private Indian refiners quietly started using yuan for some transactions in 2023. But this raised alarms in New Delhi. The Indian government grew uncomfortable with the idea of financing oil in China's currency. Given India's tense relations with China, border clashes in 2020 are still raw. The optics and strategic implications were troubling. By late 2023, India's finance ministry informally signaled disapproval of yuan payments, causing a few cargo payments to be temporarily delayed. Paying Russia is fine. Doing it in yuan is a step too far. That was the message. Officials hinted that while yuan use isn't banned, it's neither encouraged nor facilitated by the government. Most state-run refiners steered clear of yuan entirely, preferring dirhams or dollars when possible, while private companies continued to dabble in a mix of currencies as needed. For shipments priced above the $60 cap, traditional dollar transactions and insurance became tricky. Banks and insurers in G7 jurisdictions face penalties if they facilitate trades above the cap. How did India navigate this? Largely by relying on a burgeoning shadow fleet and non-Western financial channels. Hundreds of older oil tankers, often with obscure ownership and dark operations, transponders off, locations spoofed, have been repurposed to carry sanctioned oil. Many are insured by non-Western or marginal insurers, or sometimes by deliberately opaque means. For example, some ships have faked their GPS signals to appear in one location, while actually loading Russian oil in another. This clandestine network, previously used for Iran and Venezuela, ramped up for Russia's trade. If a tanker doesn't use European insurers or shippers, it can carry Russian crude priced above $60 without immediately falling foul of the cap. It's a cat-and-mouse game. Western regulators monitor such evasion, but enforcement is complex on the high seas. India doesn't openly endorse these tactics, But the reality is that much of the Russian oil docking at Indian ports arrives via these opaque logistics. As long as the cargo is delivered and the price is right, the focus in New Delhi is on securing supply, not policing tanker telemetry. In summary, India and Russia built a payment pipeline outside the dollar-dominated system. Rupees where possible, dirhams predominantly, a bit of yuan on the margins, and a lot of creative shipping and insurance arrangements in the grey zone. It's a testament to both nations' determination, Russia to keep oil revenue flowing, and India to keep oil barrels coming, that they have kept transactions moving despite the financial minefield. These workarounds are now an entrenched part of the new India-Russia oil trade. One of the most fascinating twists in this saga is how India turned cheap Russian crude into lucrative refined fuels, and even sold some of it back to the countries that sanctioned Russia. India's large refining companies quickly realized they could arbitrage the situation. Buy distressed Russian oil at a discount, run it through their refineries, and export the resulting gasoline, diesel, and jet fuel at prevailing international prices. The margins were enormous. Two private giants in particular, Reliance Industries, which operates the world's largest refinery complex at Jamnagar, and Nayara Energy, part owned by Russia's own Rosneft, led this charge. They snapped up cheap Russian crude in bulk and slashed their domestic fuel sales, instead exporting refined products for huge profits. In effect, Europe's embargo on Russian crude oil was circumvented by Europe's own demand for refined fuels. Indian companies were happy to fill European diesel shortages using Russian origin oil as input. By mid-2022, India's diesel and petrol exports to Europe and elsewhere had surged, even as Indian petrol pumps faced some shortages. Government data later showed Indian refined fuel exports hit multi-year highs, feeding markets as far-flung as Europe, Asia, and even the United States, all while using Russian crude as the underlying feedstock. This did not go unnoticed. In July 2022, New Delhi imposed a windfall tax and export curbs to rein in the refinery bonanza. The government explicitly stated that refiners were reaping major profits on exported fuel and at times drying out their fuel pumps at home to chase overseas margins. The new rules slapped export duties of 6 rupees per litre on gasoline and 13 rupees per litre on diesel, and required exporters to sell a minimum portion, 50% for gasoline, 30% for diesel, of their volumes in the domestic market. Essentially, India said, if you want to cash in on exports, make sure local consumers aren't starved and pay a tax on your super profits. These measures trimmed the sails of profiteering a bit, but Indian refiners still enjoyed a highly favorable situation, access to cheap crude when most of the world had cut Russia off. The numbers tell the story. In mid-2022, profit margins for refining diesel in Asia skyrocketed above $50 per barrel, an unheard-of level historically. Reliance and Nayara, by using discounted Russian crude, captured even more value than competitors. State-owned refiners, by contrast, were in a bind. The Indian government had frozen retail fuel prices for months to shield consumers from global price spikes, meaning state refiners sold fuel domestically at a loss, while private refiners could export at a fat profit. Little wonder that private refiners lapped up Russian oil voraciously, while state refiners, tasked with local supply, had to be nudged via policy to ensure the home market was served. From a foreign policy angle, this dynamic provided India a degree of plausible deniability. Indian officials could argue, as Jaishankar did, that India was simply a refinery hub meeting global demand, and that once Russian oil is refined, it's a new product unbound by Russian origin rules. Europe tacitly accepted this reality. After all, stopping imports of Russian crude was one thing, but Europe still desperately needed diesel and had made no law against its import, so Indian diesel, with a Russian accent, kept European trucks and factories running through 2022 and 2023. The refinery windfall also had domestic economic benefits, higher export revenue for India, healthy profits for an industry that is a big employer and taxpayer, and even some improved capacity utilization at refineries. India has long aimed to be a refining and export hub, and the Russian oil influx accelerated that trend. In a twist of fate, two Gujarat-based refineries ended up indirectly supplying Europe's energy needs, while the EU publicly frowned at India's Russian oil imports. It was a classic case of economic pragmatism outmaneuvering moral politics, with Indian companies laughing all the way to the bank. In summary, cheap Russian oil turbocharged India's refining sector. The country leveraged its sophisticated refineries to convert discounted crude into high-value products, increasing export earnings and refinery margins dramatically. It's estimated that India's refiners saved and earned billions of dollars thanks to the Russia deal, which in turn bolstered corporate profits, stock prices, and even government tax coffers via the windfall levy. This refinery-driven profit cycle is a key reason India remained steadfast in buying Russian crude. It wasn't just about securing energy, it was about making money. Beyond the immediate economics, India's Russian oil gambit fits into a larger strategy, diversifying its energy sources to enhance energy security and bargaining power. For years, India relied on OPEC for the lion's share of its crude. This made it vulnerable to OPEC's production whims or geopolitical flare-ups in the Middle East. The events of 2022 accelerated India's push to diversify suppliers, and Russia quickly became a major pillar of that effort. The numbers highlight the shift. In the fiscal year ending March 2023, OPEC's share of India's oil imports plunged to 59%, the lowest in 22 years. A year prior, OPEC had been around 72% of India's imports. Meanwhile, Russia, along with a few other ex-Soviet states, jumped to over a 26% share, a record high contribution from the Commonwealth of Independent States region. In effect, Russia displaced Iraq as India's top supplier and pushed Saudi Arabia to third place. India's import portfolio is now far more balanced between Middle Eastern oil and Eurasian oil than ever before. This diversification is strategic. By having multiple major sources, India can negotiate better terms and avoid over-reliance on any single bloc. When OPEC Plus announced production cuts in late 2022 and 2023, for instance, India could lean more on Russian supply to make up the difference. When Middle Eastern grades become pricier or scarcer, India has the Russian option and vice versa. It's a buyer's market strategy. Keep suppliers competing. Indeed, analysts noted that Russia's deep discounts were partly enabled by OPEC's tight oil policy. OPEC cuts kept benchmark prices high, which actually helped Russia sell more to India, since India needed the barrels and Russia was offering them cheaper than OPEC. Moscow and Riyadh were effectively in a quiet contest for Indian market share. Middle Eastern producers have taken notice. Saudi Arabia, UAE, Iraq, all traditional suppliers to India, have had to adjust. Some have offered more favorable terms or lock-in contracts to Indian buyers to avoid losing further ground. The landmark Rosneft, Reliance 10-year deal signed in late 2024, delivering 500,000 barrels per day to India, explicitly challenges Middle Eastern oil producers in the Indian market. India is one of the fastest-growing oil markets, so Saudi and others cannot afford to lose it. The result is intense competition for Indian demand, which only benefits India through better prices or investment deals. For example, Middle Eastern national oil companies have shown interest in stakes in Indian refineries and fuel retail, a way to secure captive market share. Diversification isn't just about economics, but also geopolitical balance. By ramping up trade with Russia, India signals to all sides that it will pursue a neutral, multi-aligned path. It won't put all eggs in one basket, neither all in the West's nor all in any one region's. After facing Western sanctions on Iran, which eliminated a source of cheap oil for India in 2019, and seeing Venezuela similarly cut off, India knows the risk of depending on sanction-prone partners. It will buy from Russia now, but also continue cultivating the Gulf states, the US, now a minor crude supplier to India, Latin America, and domestic exploration. In fact, India has periodically reminded OPEC that if prices are kept too high, it will seek alternatives. And now it has proven those aren't empty words. In essence, cheap Russian oil gave India leverage to rebalance its oil diplomacy. The country's energy security improved as it added a major new source. There's a new trade route emerging too, the International North-South Transport Corridor, INSTC, via Iran and the Caspian, which India and Russia are bolstering to move oil, among other goods. Energy ties with Russia are also expanding to coal and maybe gas, further diversifying India's import mix. By diversifying, India aims to avoid excessive dependence on any single source, Russia included. It's a delicate dance. Embrace Russia's cut-rate oil, but keep options open so Moscow doesn't gain undue influence either. So far, India appears to be succeeding. It has dramatically shifted its oil sourcing while maintaining a broad base of suppliers. This reduces the risk of future supply shocks and strengthens India's hand in global energy bargaining. In short, the cheap oil era has fundamentally altered India's energy landscape. In the near future, India will continue to tap the Russian spigot. It has every incentive to. The partnership is being locked in via long-term deals, even as payment systems and routes adjust to whatever sanctions persist.